This is Emmett Delaney, and we're going to take a look at the different forms of business ownership, just an overview of business organization types. In the United States, 80% of all businesses are sole proprietorships, yet they bring in only 13% of all revenue. At the other end of the continuum, we have corporations being only 10% of all businesses, yet they bring in 80% of all revenue. And this makes sense because if you think about sole proprietorships, typically they tend to be mom and pops and small businesses, whereas when we think about corporations, as a generalization, they tend to be much larger. If we were creating a continuum, we would have sole proprietorship at one end of the continuum and corporations on the other end. Between those two ends of the continuum, we have partnerships and then hybrids. The hybrids would consist of limited liability companies, limited liability partnerships, and Subchapter S corporations. The advantages of a sole proprietorship are that they are easily and inexpensively formed, subject to few government regulations, and they avoid corporate income tax. It's easily formed because all I have to do is just call myself a business and I'm a business. The only paperwork really necessary is if I want to start collecting and making payments in a different name, I might be required by the bank to fill out a DBA form, a doing business as form, and pay a small fee at the county. Aside from that, there are no other real regulations on that. My income that I bring in is treated as personal income, and I must pay tax on that based upon the rate that's subject there. The disadvantages of the sole proprietorship are that it's difficult to obtain large sums of capital. Most investors will not want to give money to a sole proprietorship. There is unlimited personal liability for debts, which goes counter to the other forms of organization that we'll talk about. And the life of the business is limited to the life of the founder. When the founder passes, so too does the business. It then ceases to exist. Corporations, on the other end of the spectrum, have unlimited life. They are legally declared to be an individual. They have all rights as an individual to own and sell property. They can do everything an individual can, with the exception of they cannot go to jail and they cannot vote. A corporation also has easy transferability of ownership interest. You sell your shares. If the corporation is listed on a public exchange, it's usually very easy to transfer ownership. It may be a little bit more difficult if it's not listed on an exchange, but still a corporation. Nevertheless, it's much easier to do so than other forms of organization. And there is limited liability associated with a corporation. The disadvantages would be that it is subject to double taxation. Since a corporation is a legal individual, that corporation must pay tax before it distributes it to its shareholders. The shareholders then, upon receiving that, must pay tax on it again. So there's the double taxation that occurs there. And a corporation is very complex and time-consuming to set up. There are many firms that specialize in doing so. It's a very costly process to do. If we look at some of the hybrids, the limited liability company and the limited liability partnership, the advantages there are that the management authority can be delegated to specific members or to professional managers who are not members of the LLC. Members have the same protection from personal liability as officers or shareholders of a corporation. Once the operating agreement is formed, there are a few other formalities. The limited liability company itself does not pay federal income tax. There are no restrictions on multiple classes of stock. There are no restrictions on the number or type of owners. I can have as many owners as I want to. Those owners can be of different type. Those owners can have different roles. Those owners can have different distributions going to them. I don't pay federal income tax because it's a pass-through organization. Whatever money comes in goes to the owners / members, as they're called, and they must pay taxes on that as personal income. I do have the limited liability protection, which is there, and I can have managers who are running the LLC. The disadvantage is that a member who is also a manager may be required to treat their share of income as self-employment, which means it's subject to the additional taxes and funding the Social Security and Medicare. If an individual worked for a corporation, that individual would have to pay tax on the money that they earn. If that individual works for an LLC and is also a member, they may be paying more tax than what they would pay if they were taking a W-2 income with a corporation. LLCs are regulated by state. Every state sets up different rules. In most states, the death or withdrawal of a member will trigger the dissolution. In some states, the LLC does not qualify for the same state tax credits or sales and property tax exemptions that corporations would qualify for. And because of these things, some venture capitalists will choose not to invest in an LLC. A Subchapter S is a little bit more difficult to form and maintain than an LLC. You have to keep records of the board and shareholder meetings. You have to follow a little bit more guidelines and structure than what you have with the LLC. There's only one class of stock which is available. All are equal. And it's limited to 100 shareholders. You cannot have more than 100 shareholders. You can, however, have multiple members of the same family declared as one shareholder. So theoretically, you can have up to 100 different families who are involved in the Subchapter S. Proportional income distributions go with ownership since there is only one class of stock. The Subchapter S, however, which is really nothing more than one of the elections that you make under Chapter 1 of the Internal Revenue IRS Code, the Subchapter S can offer some tax benefits. It's important to note that with the corporation, the Subchapter S, if you are a member, an owner of the company, you must be paid a salary if you own more than 2% of the company. In contrast, an LLC is not obligated to pay a salary to its members, and because of that, there can be some tax obligations or implications for single-person ventures. So if we look at an example here, let's say that we have a one-owner organization, and it can either structure itself as a Subchapter S or an LLC. The purpose of this is to make money, and the individual wants to have $100,000 income coming to them at the end of each year. If we look at it being structured as a Subchapter S, they can choose to have that $100,000 coming as $20,000 in salary and $80,000 in distributions. Whereas the LLC cannot take a salary, and so it must take the $100,000 as a distribution. The income tax under both of these situations would be the same. So the individual would pay $40,000 in income tax. The payroll tax, however, would be different. The individual would only pay the payroll tax on the $20,000 that they receive under the Subchapter S, whereas they would have to pay the payroll tax on the whole $100,000 that they receive under the LLC. Now, we can argue that this makes a difference because the other half of the taxes would be paid by the Subchapter S. Either way, the corporation is paying it, but still what the individual is receiving is different. The total tax then for the Subchapter S would be $43,000, whereas for the LLC, if it's structured that way, would be $55,000. So there can be a tax implication, a tax difference there, and based upon this scenario. If we look at some terminology differences that are here, the legal documents creating an LLC are called the Articles of Organization, whereas with the Subchapter S, they're called Articles of Incorporation. Probably the most important legal document, though, for an LLC is an operating agreement. And the operating agreement can be changed on a very regular basis, but it's what defines what that LLC exists for. The owners of the LLC are called members, whereas the owners of the Subchapter S are called shareholders. There's a limit on who can be an owner. With an LLC, anyone can, and you can have an unlimited number of them, whereas with a Subchapter S, corporations, partnerships, and LLCs that have multiple members, as well as LLPs and some others, are restricted. They cannot be an owner of the Subchapter S corporation. Shareholder meetings are not required with an LLC. They are with the Subchapter S. Limited liability is there in both instances. And once again, we have the limitation there of 100 shareholders with the Subchapter S and an unlimited number with the LLC. Hopefully this has been a helpful look at some of the forms of business ownership that are popular today. This is Emmett Delaney.